I am betting that 2026 is going to be the year of the consumer packaged food stock, and I'm making this video to talk about why. So let's look at Conagra brands to start. Conagra owns household names like Duncan Hines, Ready Whip, Marie Callender's, Boom Chicka Pop, Orville Redenbacher, Slim Jim, and a couple of other names. And you can see that they have done nothing besides go down for 3 years. And really, almost 5 years. And this is exactly what I like to look at, which sounds crazy, but we'll get into why. So looking at a couple of the basics, market cap for the company is $8.5 billion. So if you had $8.5 billion in the bank, you could own all of Conagra. Dividends 7.8%, and they are using about 60% of their free cash flow to pay out this dividend, which is really pretty good. It's not eating up a ton of the money that they're making, so they have some money left over to either pay down debt or buy back stock or whatever else they might want to do. So what I like to look at first and foremost is the revenue of the business. And you can see that revenue went up a good bit, kind of trailed off, and it's coming down some, which is a red flag. But we'll get into why I'm not too concerned about that. So I like to look at pre-COVID and post-COVID. Here after COVID, 2021, 11 billion, popped up to 12.28 in 2023, came down a little bit to 11.6 for this past year. You can see that their fiscal year ends in May, and I'm going to assume that's just going to probably start to trail off here. But 2020 to now, it's been essentially flat, which isn't too bad, all things considered. Net income also relatively flat, 840 million in 2020, popped up to 1.3, probably some kind of big acquisition, and then trailed off a little bit, but we're going to talk about why here. So a lot of these food stocks, the companies have been selling off because of their input inflation. So you've got the cost of raw material, whether it's the boxes that the food goes in or the wheat that goes into making the food, in the case of maybe Kraft Heinz, which we'll look at here in a minute. Beef prices are through the roof, and they're continuing to go through the roof. So that'll affect someone like Conagra, who has a lot of frozen meals, Slim Jims, stuff like that. But generally speaking, this company is just kind of flat. Their EBITDA is similar, coming up to 2.2 billion in 2020, and then doing pretty much nothing for the 5 years after that. So what we're going to do is just take a look at, I like to look at free cash flow, because you can't really fake free cash flow. It is the money coming into the business after everything else is paid, and it is the actual tangible cash. Whereas earnings, I can say that my business had $1 million in earnings, but, we might have $1.5 million of accounts receivable. So, what good is that if it's not actually cash coming to the bank? So free cash flow for Conagra, again, flat. You can see everything about this business is flat. It's come down a little bit, it's popped up, it's come down a little bit, it's popped up. I know they sold off some of their businesses like Chef Boyardee here this past year, but I'm going to go ahead and just underwrite Conagra as if it's going to do $1 billion in free cash flow, because that seems to be kind of the long term. If we take the highs and then we take the lows and we average it out, probably about $1 billion is safe. So we'll just say this company is going to generate $1 billion forever. It's never going to grow. You're paying $8.5 billion for it, so you'll get all your money back. Year 8, year 9, somewhere in there. So you're looking at about a 9% annualized return. Where this gets kind of interesting, though, is if you look at the long-term price to free cash flow or price to EBITDA that the industry, the stock market has paid for this company. So after COVID, your price to EBITDA was around 7, 8. Currently, it's around 4. Let's take a look at price to free cash flow. The price to free cash flow, 2021, it was 11, 12. Got as high as 25 in 2023, which is kind of crazy. And then we're down here around 7. So really all I'm looking at is kind of reversion to the mean. So if we're at 7 now, let's say we get up to 12. That's probably a good average. So what's that going to be? Like a 70% return? Something like that? Yeah. So from 7 to 12 times free cash flow, probably a 70% return. 12 times free cash flow on $1 billion company is going to be, what, $12 billion, obviously. We're trading at 8 and some change right now. So 60% return, maybe? 8 times 1.6. 50% return, probably. Yeah, of course. 8 plus 4. So we're looking at a 50% return on Conagra as it reverts to the mean, which is exactly what I like to look for. And then it's going to pay us a nice dividend while we wait. So Flowers Foods, similar situation. This is a bread manufacturer. They own Dave's Killer Bread. They own Nature's Own, Wonder Bread, all that good stuff. Similar deal. 9% dividend yield, 65% free cash flow payout ratio. This one's even more wild. Their long term is like 20 times free cash flow, I think. Let's see. Yeah, so I mean, like down here on COVID, we got to about 14, spiked up to 45, which is just crazy for a company that doesn't grow, and then down to around 20 again. So I'm thinking, 15 times free cash flow is probably fair for a company like this. So let's just take a look. Oh, they're 1.2% today. That's pretty good. Free cash flow on Flowers Foods. Long term, no growth. That's fine. I don't care. We're going to call it 200 million. They just bought Simple Mills, a cracker company too, which is kind of cool. So they're going to do 200 million in free cash flow. They're going to revert to the mean at 15 times. So it'll be a $3 billion company. So 40% return, and you'll get a 9% dividend while you wait. So a lot of what I like to do is just look for these reversion to the mean opportunities, especially right now. You've got AI and tech and everything just blowing the doors off the market. And so what I think is going to happen is as these tech multiples become compressed and the market moves out of tech, and simultaneously you have the Fed cutting rates, I think that people are going to start looking at these high dividend paying companies like Flowers Foods that's paying a 9% dividend. Another good one's Kraft, paying 6.5% dividend. Constellation's not so cool, 2.8, but Molson Coors is all right too, 4%. So you're going to have these high cash cow dividend paying companies that I think people are going to start to move their money into as they move out of the Nvidias and the CoreWeaves and whatever else in the world. So each of these companies, similar deal. Kraft Heinz, 6.5% dividend, about a 52% payout ratio. I think a lot of the fear right now with Kraft Heinz is the fact that the company is being split up. So, they're buying back stock here recently, which is nice. Kraft, when they went public, or I guess I should say after they merged, Kraft and Heinz, I think that was in 2017, 2016. You can see that the market just went crazy for this company because Warren Buffett underwrote it. He's the one who made the merger happen through 3G Capital. So everyone got really excited about Kraft. But as he came back down to earth, we got down here to around 10 times free cash flow, which is pretty sensible for a company that's not doing much. And that's about where they're trading at now, 8 times free cash flow. Again, I think that the market's going to start to move into these more safe names, as you might say. So we'll get up to 12, 15 times free cash flow, probably another 50% return. So my bet here is that a lot of these names are going to start to rotate into them. You can see Constellation's already started to get a little bit of rotation here over the past month. It's about 15%. Usually I'd get pretty excited about that and take profits once I start to see weakness here. But, you're getting paid a dividend to wait. They're paying out a little bit more than a third of the free cash flow. And then they're using a lot of the free cash flow as well to buy back stock, which I like to see. Course is doing something similar. Got about a 12% free cash flow yield. You're getting a third of it as a dividend, and then the other third is going into buying back stock. So this is where I'm putting most of my eggs right now for next year, is just in all these beaten down consumer packaged names, and we will see what happens moving into 2026.